When most people hear about El Niño or La Niña in the news, they think of weather, rainy winters in California, hurricanes swirling in the Atlantic, or droughts parching Texas ranch lands. But what is often overlooked is that the El Niño Southern Oscillation, or ENSO, is as much an economic force as it is a climate one. This shifting cycle of warming and cooling waters in the tropical Pacific Ocean reaches into the very fabric of the US economy, influencing everything from the cost of gas at the pump to the price of groceries in the supermarket. Wall Street traders pore over ENSO forecasts as closely as weather maps, while lawmakers in Washington, D.C. prepare disaster relief bills with one eye on the Pacific Ocean. Insurance firms set premiums based on ENSO probabilities, and corporations build contingency plans around its swings. When ENSO shifts, so too does the financial health of millions of American households. To understand how ENSO translates into dollars and cents, you must first appreciate its grip on agriculture. America's breadbasket is exquisitely sensitive to rainfall and temperature patterns, and ENSO is one of the strongest levers shaping those conditions. In El Niño years, wetter conditions often blanket parts of the Midwest, delaying planting schedules and increasing the risk of floods that drown crops before they can mature. This cuts yields of corn and soybeans, the backbone of the global food system, and pushes prices higher. In La Niña years, the opposite occurs. Prolonged drought bakes fields, cutting yields just as sharply. Farmers face devastating losses either way, and the volatility ripples outward. Corn shortages drive up feed prices for livestock, which then raises the cost of beef, pork, and poultry. Soybean shortages affect everything from cooking oil to processed foods. Even ethanol production, heavily tied to corn, can falter, nudging up gas prices as ethanol blends become more expensive. When ENSO tightens its grip, grocery bills rise, restaurant menus change, and consumers feel the sting in their wallets. Gasoline prices, already volatile due to geopolitics and global demand, are also tied to ENSO through energy infrastructure and supply chains. During La Niña winters, colder than normal conditions across the northern United States drive up demand for natural gas and heating oil, pushing prices higher. If pipelines or refineries are disrupted by storms, such as the ones more likely during active hurricane seasons fueled by La Niña, the supply side tightens, exacerbating the spike. El Niño winters, by contrast, often bring milder conditions to the north, reducing heating demand and stabilizing energy costs. But El Niño also fuels wetter, stormier weather across parts of the US, which can knock out energy infrastructure through flooding, high winds, or landslides. The connection between ENSO and hurricanes is particularly critical. La Niña years tend to foster more active Atlantic hurricane seasons by reducing wind shear, the atmospheric force that normally disrupts developing storms. This increases the odds of storms like Katrina, Harvey, and Ian, each of which inflicted tens of billions of dollars in damages. Katrina alone caused over 160 billions in losses, much of it tied to destroyed energy infrastructure and disrupted supply chains along the Gulf Coast. Harvey dumped more than 60 inches of rain on Houston in 2017, flooding refineries and petrochemical plants, causing billions in production losses and sending gasoline prices soaring nationwide. Ian in 2022 battered Florida with winds and storm surge that devastated entire neighborhoods, while straining insurance companies already reeling from prior disasters. Each of these storms had ENSO fingerprints, reminding policymakers that ocean temperatures thousands of miles away can dictate how much Americans pay to fill their tanks. The insurance industry may be the sector most directly affected by ENSO. Every storm season, insurers calculate risks based on whether El Niño or La Niña conditions are expected. A forecasted La Niña year sends shivers through the industry as actuaries anticipate heightened hurricane activity and prepare for an avalanche of claims. Reinsurance companies, those that insure the insurers, also adjust their models, raising rates for policies covering coastal properties or flood-prone areas. These adjustments flow directly to homeowners and renters who see higher premiums or find coverage harder to obtain. After Hurricane Sandy in 2012 inflicted more than $70 billion in damages across New York, New Jersey, and surrounding states, insurers recalibrated their exposure to northeast storms, tying ENSO more closely into their risk models. Sandy's unusual track, partly influenced by large-scale atmospheric patterns that ENSO helps shape, highlighted that even regions unaccustomed to major hurricanes are not immune. For the insurance industry, ENSO is not merely a climate variable, it is a financial determinant. Billions of dollars ride on whether warm or cool waters dominate the Pacific. Wall Street has also become an unlikely ENSO watcher. Commodity traders track ENSO forecasts because they know how directly they affect agricultural outputs and energy demand. If NOAA issues an advisory that a strong El Niño is forming, futures markets for corn, soybeans, and wheat react almost instantly. Investors bet on reduced yields or flooding disruptions, and prices swing accordingly. Hedge funds deploy algorithms that ingest ENSO data alongside rainfall forecasts and soil moisture reports, translating Pacific Ocean conditions into buy or sell orders on the Chicago Board of Trade. Energy traders watch ENSO for its implications on natural gas demand in winter or hurricane disruptions in summer. A predicted La Niña season, with its higher hurricane risk, can send oil futures climbing as traders brace for refinery shutdowns along the Gulf Coast. These financial maneuvers may feel distant to everyday households, but their outcomes filter down to the checkout line and utility bill. The cost of bread, the price of milk, and the stability of heating bills are influenced by decisions made in financial markets that hinge on ENSO cycles. Washington, D.C. is equally invested in ENSO monitoring. Federal agencies rely on ENSO forecasts to allocate resources for disaster preparedness and recovery. The Federal Emergency Management Agency, FEMA, uses ENSO data to pre-position supplies ahead of likely flood or hurricane events. The Department of Agriculture incorporates ENSO probabilities into crop insurance programs, adjusting payouts and premiums to shield farmers from catastrophic losses. Congress, too, reacts to ENSO-driven disasters by passing emergency spending bills that inject billions into recovery efforts. After Katrina, federal disaster aid exceeded $120 billion. After Sandy, another $50 billion flowed. Harvey and Ian prompted tens of billions more. Each of these aid packages was shaped not only by the immediate damage, but also by the expectation that ENSO patterns would continue influencing the severity of future events. Policymakers know that failing to account for ENSO is fiscally irresponsible. The cycle dictates not just weather, but the economic vulnerabilities that demand public funds. The scale of damages ENSO-related storms inflict is staggering. Katrina's $160 billion, Sandy's $70 billion, Harvey's $125 billion, and Ian's $113 billion are not just abstract numbers. They represent destroyed homes, lost jobs, shuttered businesses, and destabilized communities. They also represent enormous transfers of wealth, from taxpayers footing federal relief bills, from insurers raising premiums, from consumers paying higher prices, and from investors trying to anticipate market swings. Economists estimate that ENSO events cost the global economy trillions when accounting for disrupted trade, food price spikes, and infrastructure losses. For the US alone, the annual toll of ENSO-related disruptions runs into the tens of billions, even in years without headline-making disasters. Droughts that reduce crop yields by 10% can erase billions in export revenue. Floods that damage highways or rail lines ripple through logistics networks, slowing commerce and raising costs. The economy does not need a Katrina-level storm every year to feel ENSO's pinch. It suffers steadily through smaller cumulative blows. Another way ENSO touches wallets is through food inflation. For households, this is often the most visible and painful consequence. A La Niña drought in the Midwest cuts corn yields, and suddenly everything from breakfast cereal to beef carries a higher price tag. During El Niño years, flooding delays harvests, tightening supplies of soybeans, wheat, and rice. Food processors pass on higher input costs to supermarkets, and families feel the squeeze at checkout. In some cases, food price inflation lingers long after ENSO conditions fade, as reduced inventories take time to rebuild. This is particularly hard on lower-income families who spend a larger share of their earnings on food. ENSO-driven inflation does not stay confined within borders either. Reduced US exports during bad crop years tighten global markets, raising prices for countries dependent on American grain. These shocks can trigger political instability abroad, underscoring how ENSO is not just an environmental issue, but a geopolitical one. Energy bills follow a similar trajectory. When La Niña drives colder winters, demand for heating spikes, sending natural gas prices higher. Utilities pass those costs on to households, often during the harshest months when heating is essential. When El Niño brings milder conditions, bills may stabilize, but the respite is often offset by storm damage to energy infrastructure. Consumers pay indirectly through higher repair costs and long-term investment in grid resilience. In either case, ENSO guarantees that energy bills are never fully insulated from global climate patterns. And in a world where climate change is intensifying extremes, ENSO swings may grow sharper, meaning future households could face even more volatile energy costs. The growing sophistication of ENSO forecasting offers some hope. NASA and NOAA's improved satellite monitoring, buoy networks, and computer models mean that ENSO forecasts are now available up to 9 months in advance. This lead time allows businesses, governments, and households to plan. Farmers can decide which crops to plant, insurers can adjust policies, and energy providers can stockpile reserves. Wall Street and Washington use the forecasts to position themselves strategically, reducing the element of surprise. Yet forecasting cannot eliminate the risk, it can only mitigate it. ENSO remains a natural cycle that humanity cannot control, only adapt to. The challenge is ensuring that adaptation keeps pace with the economic stakes. For the everyday American, the critical takeaway is this: ENSO is not just a weather story, it is an economic story. It dictates how much you pay at the grocery store, how high your heating bill climbs, and how secure your job in agriculture, energy, or insurance might be. It is a reminder that the Pacific Ocean, thousands of miles away, is in many ways your most influential neighbor. Every shift in its waters sets off a cascade of consequences that eventually reach your wallet. Wall Street knows it. Washington knows it. The insurance industry knows it. The question is whether ordinary households will begin to see ENSO not as abstract climate jargon, but as a central player in their financial lives. Because in truth, the US economy is on the line every time ENSO shifts. And that means so is your wallet. The hidden hand of ENSO is most clearly visible when you trace how disruptions in weather cascade into the broader US economy. Start with agriculture, where profit margins are already razor thin and every season carries enormous risk. Farmers base their decisions on seasonal forecasts, seed prices, and global demand. When ENSO enters the picture, it can rewrite those calculations overnight. A La Niña drought across the Midwest reduces yields, leaving farmers not only with smaller harvests, but also with higher costs for irrigation, crop insurance claims, and supplemental feed. These losses ripple through rural economies where farming income supports local businesses, equipment dealers, and service industries. Conversely, El Niño years with excessive rainfall can delay planting, make fields inaccessible, or increase the spread of crop diseases, all of which eat into profits. Neither scenario is favorable, and both reveal the vulnerability of the American agricultural machine to forces beyond its control. By the time these impacts reach supermarket shelves, the public sees only the end result, rising prices. But behind each price tag lies a chain reaction, triggered by ENSO conditions thousands of miles away in the Pacific Ocean. Livestock and dairy producers are equally exposed. During prolonged droughts tied to La Niña, ranchers in Texas and the Southwest face barren pastures. When grass fails, herds must be fed with purchased hay and grain, whose prices are already inflated by poor crop yields. Some ranchers make the painful choice to sell cattle early, flooding the market and temporarily driving prices down. Months later, however, beef prices rebound sharply because fewer cattle remain in the pipeline. Consumers often wonder why meat prices swing so wildly from one season to the next. ENSO is often the culprit. Dairy operations experience similar pressure as water scarcity increases feed costs while also stressing livestock. Even poultry producers, who rely heavily on corn and soybean feed, feel ENSO's bite when feed prices soar. Every segment of animal agriculture is caught in ENSO's feedback loop, and every household that buys groceries shares in the consequences. Energy markets provide another lens through which ENSO reveals its influence. During La Niña winters, the colder-than-normal conditions across the northern US create surging demand for heating fuels. Natural gas prices spike as utilities scramble to meet consumption and consumers see higher bills. Oil demand may also rise, especially for heating oil in the northeast. The opposite occurs during El Niño winters, when milder conditions reduce heating demand. But those same El Niño patterns may drive more frequent storms that damage energy infrastructure. Hurricanes fostered by La Niña are particularly costly. When Hurricane Harvey struck Houston in 2017, it temporarily shut down nearly a quarter of US refining capacity. Gasoline prices jumped nationwide, illustrating how a single ENSO-influenced storm could send shockwaves across the economy. The link between ENSO and energy is not abstract. It is the reason your winter heating bill or summer gas price can fluctuate wildly in ways that have little to do with local supply and demand. Insurance companies have perhaps the most direct financial stake in ENSO forecasts. Every spring, actuaries look to NOAA's outlooks for clues about whether the coming hurricane season will be shaped by El Niño or La Niña. A La Niña forecast, with its greater hurricane risk, leads insurers and reinsurers to raise premiums, limit coverage, or increase reserves. For homeowners along the Gulf and Atlantic coasts, this translates into higher insurance costs or even non-renewal notices. After major disasters like Katrina, Sandy, Harvey, and Ian, insurers often exit markets altogether, leaving state-backed insurance pools to pick up the slack. The cost of rebuilding these communities is borne not just by insurers, but by taxpayers and homeowners across the country. This dynamic reveals how ENSO events can shift financial burdens from one group to another, effectively redistributing costs throughout the economy. Insurance is meant to spread risk, but when ENSO amplifies that risk, the system itself strains under the weight. Wall Street has turned ENSO into a line item in its forecasting models. Hedge funds, commodity traders, and investment banks know that ENSO signals are predictive of market swings months in advance. If NOAA warns of a developing El Niño, traders might anticipate wetter conditions in California, betting on higher yields for certain crops or lower heating demand in the northeast. Conversely, a La Niña advisory prompts bets on reduced agricultural production, higher feed costs, and stronger hurricane activity. These positions influence futures prices, which in turn affect the real economy. Farmers lock in contracts at different prices, food companies adjust supply chains, and even restaurants plan menu costs around expected swings. It is striking that decisions made on trading floors in Chicago or New York are influenced by ocean currents thousands of miles away. Yet this is the essence of ENSO's reach. It links distant Pacific waters to the financial heartbeat of the US economy. Policymakers in Washington, D.C. also track ENSO closely because the stakes are enormous for federal budgets. Disaster relief bills have become a recurring feature of Congress, often passed in the wake of ENSO-fueled hurricanes or floods. After Katrina, Harvey, Sandy, and Ian, billions in federal aid were allocated to rebuild communities, restore infrastructure, and support displaced families. These massive expenditures are not planned in advance, but are reactive, straining fiscal priorities. ENSO forecasts give policymakers some warning, but they cannot eliminate the need for emergency spending when disasters strike. Beyond direct disaster aid, ENSO also shapes farm subsidy programs, crop insurance payouts, and energy policy. A drought in the Midwest means larger federal insurance payments to farmers, while a flood in California may prompt new water infrastructure investments. In each case, ENSO forces Washington to respond, reshaping budgets and legislative agendas. For lawmakers, ignoring ENSO is not an option. It is one of the hidden drivers of fiscal policy. The cumulative damages ENSO-linked disasters cause are measured in the hundreds of billions of dollars, but the true cost lies in their persistence. After Katrina's $160 billion toll, New Orleans and surrounding communities spent years rebuilding, with many residents never returning. Sandy's $70 billion price tag reshaped insurance practices and infrastructure planning along the East Coast. Harvey's $125 billion in damages disrupted Houston's energy hub, reverberating across global oil markets. Ian's $113 billion hit Florida's housing and insurance markets with a force that continues to ripple today. Each storm is remembered as a singular tragedy, but collectively they illustrate ENSO's economic might. The pattern is clear. When ENSO tilts toward La Niña, hurricane risk rises, and when storms hit, the costs are staggering. These costs do not vanish. They are borne by taxpayers, insurers, investors, and consumers in every corner of the country. Food price inflation offers a particularly visceral example of ENSO's influence. When ENSO distorts weather, harvests suffer, and prices rise. Families may not understand why ground beef, milk, or bread is suddenly more expensive, but ENSO is often a hidden cause. These food price spikes are not only inconvenient but destabilizing, especially for low-income households that spend a greater share of income on groceries. Economists track food inflation closely because it fuels political discontent and pressures central banks to adjust interest rates. ENSO, in this way, indirectly shapes monetary policy. If La Niña drives drought and pushes food prices up, inflationary pressure may prompt the Federal Reserve to tighten monetary policy sooner than expected, influencing everything from mortgage rates to stock market valuations. ENSO's reach extends far beyond farms. It penetrates the very core of economic governance. Taken together, the picture is clear. ENSO is a silent economic force, redistributing wealth, reshaping markets, and dictating costs for ordinary Americans. It does not operate on Wall Street or in Washington, but its cycles are embedded in their calculations. Every shift in Pacific Ocean currents is translated into higher or lower prices, bigger or smaller insurance claims, and more or less disaster aid. For the public, the key is to recognize that ENSO is not only about rainfall totals or storm counts, it is about your wallet. It is the reason why gas prices jump unexpectedly, why insurance premiums rise, and why groceries feel more expensive than last year. The Pacific Ocean may seem distant, but ENSO ensures that its influence is as close as your bank account balance. ENSO's impact on the US economy is not only cyclical but cumulative, building layer upon layer of vulnerability that touches every household. Consider how supply chains respond when ENSO shifts weather patterns. A flood that wipes out rail lines in the Midwest forces companies to reroute shipments by truck, raising transportation costs. A drought that lowers the Mississippi River's water levels makes barge traffic more expensive and less efficient, driving up the cost of grain and coal deliveries. When hurricanes knock out ports or refineries, entire industries are disrupted, with shortages rippling from one region to another. These disruptions are not short-lived. They linger for months, sometimes years, embedding ENSO into the long-term economic landscape. The system may eventually recover, but consumers rarely see prices fall back to pre-crisis levels. Instead, ENSO resets the baseline, pushing costs higher with each cycle. For businesses, this means constant adaptation. For households, it means living with the hidden tax of climate volatility. Financial institutions increasingly model ENSO as a systemic risk. The World Bank, the International Monetary Fund, and US financial regulators acknowledge that climate variability with ENSO at its center can destabilize economies. A La Niña-driven drought that decimates crops can trigger higher global food prices, fueling inflation and political instability abroad. In the US, those same shocks tighten household budgets, strain credit markets, and complicate monetary policy. Wall Street analysts treat ENSO advisories as leading indicators, feeding them into global risk models alongside oil prices and interest rates. Insurance companies model ENSO to determine capital reserves, while banks assess it as part of loan risk for farmers, utilities, and coastal real estate. This embedding of ENSO into financial systems shows just how deeply its cycles are woven into the economy's foundation. What began as a climate phenomenon now sits alongside GDP and employment numbers as a factor in financial decision-making. The federal government is adapting as well. NOAA and NASA provide ENSO forecasts that flow directly into agricultural subsidies, disaster readiness programs, and military logistics. The Pentagon, for instance, has identified ENSO-driven disasters as potential security risks, knowing that hurricanes or floods can disrupt bases, energy supplies, and humanitarian missions. FEMA pre-positions resources months in advance based on ENSO predictions, acknowledging that the scale of damage often correlates with the cycle's phase. Lawmakers debate relief bills not only after disasters but in anticipation of them, guided by NOAA's outlooks. In this way, Washington, D.C. tracks ENSO as closely as it does tax revenue or unemployment data, understanding that the cycle's swings carry both human and fiscal consequences. For individuals, recognizing ENSO's influence provides perspective on the fluctuations they face daily. That spike in gas prices during a cold winter may not be just geopolitics. It could be La Niña's colder than normal conditions. Rising beef prices at the supermarket may not stem solely from supply chain issues. It could be drought conditions stressing pastures in cattle country. Higher insurance premiums on coastal homes may not only reflect company greed, they are tied to actuarial models of hurricane risk during La Niña years. Seeing ENSO as the hidden driver helps people understand that these costs are not random, but part of a global pattern. This understanding is the first step toward preparing for its impacts, whether through smarter personal budgeting, advocating for stronger disaster preparedness, or supporting investments in resilient infrastructure. The conclusion is unavoidable. ENSO is not a side note in the weather section of the news. It is a central player in the US economy, shaping costs, risks, and policies that affect every American. From farms in Iowa to refineries in Texas to households in New York City, its reach is inescapable. The billions in damages from Katrina, Sandy, Harvey, and Ian are not isolated events. They are symptoms of a deeper cycle that recurs with regularity. Wall Street knows this, Washington knows this, and insurers know this. The question is whether ordinary citizens will learn to recognize it too, so they can demand smarter responses and adapt their own choices. Because ENSO will not stop. It will continue to tilt the scales of the US economy, sometimes gently, sometimes violently, always with consequences that touch your wallet. If you want to stay ahead of the forces that shape both your environment and your economy, make sure you subscribe to Holy Path Insights. We'll continue to uncover the connections between global climate cycles and the financial realities of everyday life. Understanding ENSO is not just about predicting the weather. It's about protecting your future, your finances, and your family.